Welcome to PIMCO Pod. In this episode, we discuss the efforts to make private credit tradable face obstacles and risk undermining one of the main reasons earning an illiquidity premium that investors look to private assets. Stay tuned after the conclusion of the podcast for additional important information. Spreads may be converging across public and private markets, but liquidity is not. By Lotfi Karui. Proposals to engineer secondary trading in private assets, often championed by vocal critics of public market liquidity, have gained renewed momentum. For some, enhanced tradability is viewed as a remedy to growing unease over the absence of transparent real-time valuation signals in private portfolios. For others, secondary trading is presented as a way to mitigate jump risk in direct lending credit portfolios, where loans are commonly carried at par until fundamentals deteriorate and repricing becomes unavoidable. This debate is unfolding against a notable backdrop. Public credit market liquidity today is as strong as at any point since the global financial crisis, while spreads between less liquid direct lending and more liquid public credit have compressed materially in recent years. For investors, this raises a fundamental question. Am I being adequately compensated for the illiquidity I'm assuming in private markets? In our view, the answer is often no, particularly in corporate credit. The promise of greater secondary liquidity in private assets is, in some cases, being used to justify a meaningful erosion of the illiquidity premium in direct lending relative to public markets, rather than to genuinely improve investor outcomes. More structurally, we see several key obstacles to creating meaningful liquidity in private credit. Permissioned transfer of loans. Unlike public markets, many private credit documents require borrowers to consent to any sale or transfer of their loan from the lender or lenders of record. Information asymmetry. In private credit, buyers often lack access to credit agreements, amendment details, collateral packages, or standardized financial documents. This information has been paramount to building confidence and liquidity in public markets and is completely ad hoc in today's private credit market. Confidentiality. Non-disclosure agreements are often required for any information to be shared with potential loan purchasers, adding to the information asymmetry. Lack of trading infrastructure. Private credit markets lack centralized reporting, execution, or settlement infrastructure, all details that have become integral to the build-out of robust liquidity in public markets. While public markets and 144A private placement deals can trade seamlessly, many private investment-grade and direct lending deals have the additional challenges of physical settlement, which can be onerous for both buyers and sellers. Incentives. Not all private market participants have the same desire for an increase in liquidity. Some prefer the opacity in private markets, while others want to avoid mark-to-market volatility that more often aligns with public markets. Even if some of these obstacles are addressed, private markets exist precisely because many assets are idiosyncratic and negotiated, making continuous price discovery difficult and often economically inefficient. Attempts to force liquidity into these markets tend to produce thin trading, wide bid-ask spreads, and unreliable price signals. Rather than improving transparency, sporadic secondary trades often introduce noise, reflecting liquidity needs rather than underlying fundamentals. The illiquidity premium is the point. There is also a deeper economic tension. A core appeal of private assets is the illiquidity premium earned by long-horizon investors willing to lock up capital. If private assets were to trade frequently and reliably in secondary markets, that premium would inevitably erode, undermining one of the primary reasons investors allocate to private assets in the first place. Further, much of the debate around increased liquidity in private credit conflates true private assets with 144A private placements, which have been liquid for more than 2 decades. Recent headlines, driven by a small number of large transactions, including Meta's $27 billion data center financing, highlight the depth of the 144A market, not a structural improvement in liquidity for private credit. For context, 144A securities represent roughly 18% of the US dollar investment grade IG market and 82% of high yield HY, with monthly trading volumes hovering around $200 billion in IG and $100 billion in HY. It is therefore essential to distinguish the established liquidity of 144A markets from the persistent illiquidity of true private credit, investment grade or otherwise. Why the syndicated loan playbook doesn't translate. Finally, while the evolution of the broadly syndicated loan market is often cited as evidence that a once private asset class can become relatively liquid and tradable, that comparison overlooks a key distinction. The broadly syndicated loan market's path to liquidity relied on heavy standardization and the rise of dedicated vehicles, such as collateralized loan obligations, CLOs, and more recently, ETFs, that created consistent secondary demand. It is far from clear that private credit can or should follow the same path, and if it did, many of the features that at times make private credit attractive to borrowers, including certainty of execution and the ability to provide bespoke capital solutions, would likely be diminished. A question of risk and compensation. The absence of continuous mark-to-market pricing in private assets should not be viewed as structural flaw. Rather, it reflects a distinct risk profile, one for which investors must be explicitly and adequately compensated. Importantly, this risk is not static. Investors' liquidity needs, constraints, and preferences can evolve over time. Managing this dynamic liquidity risk has therefore given rise to a mature, though costly, ecosystem of solutions, including limited partner, LP interest transfers, general partner, GP stake transactions, continuation vehicles, and broader portfolio-level strategies, all designed to provide flexibility and address shifting liquidity demands. Thank you for listening. That was Spreads May Be Converging across public and private markets, but liquidity is not. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.